Investors prepare for the biggest series of Fed hikes in almost 30 years. The Bank of Japan's decision to keep rates low pushes the yen to its weakest level in 20, and billionaire Elon Musk pursuing one of the biggest leverage buyouts of all time. This is Bloomberg Wall Street Week. I'm Romaine Bostick, in for David Weston. This week, special contributor Larry Summers, as we prepare for one of the most consequential Fed meetings in years.
My guess would be that the Fed's going to need to go further.
And former Federal Reserve Governor Randy Kroszner on whether the Fed can engineer a soft landing.
That's really, really tough because the economy is clearly slowing down. I think the probability of recession has gone up quite significantly.
The week began with the war in Ukraine now entering its third month.
Russia is on its heels right now. We've heard this refrain, well, look, we hate to see this might become a nuclear conflict.
We want to see Russia weakened to the degree that it can't do the kinds of things that it has done in invading Ukraine.
And Russia cutting off the flow of natural gas to some of its neighbors.
Ursula von der Leyen basically called it blackmail by Russia. Is the blackmail working? Is Russia basically saying, we're going to wield our sword and just look at Poland, look at Bulgaria?
The looming specter of recession seeping through everything as well when GDP here in the U.S. came in with a surprise contraction.
Bloomberg Economics called the first quarter a pothole. It's a rather deep one.
Closer to home, Elon Musk made it official with Twitter, creating even more questions than answers.
Attention quickly turns to when does Elon Musk get to implement changes that he's proposed, or how does that work? Is he literally walking into Market Street, into the offices and saying, hey guys, I'm here, I've got some ideas, let's talk about it.
A mixed bag of earnings out of tech companies.
Apple, that is out. Let's take a look at second quarter revenue, $97.3 billion versus estimates of $93.98 billion. So a big beat there.
Alphabet, parent company of Google, down more than 6.5% in after hours. A rare miss in the first quarter. Miss on the top line, $56 billion of revenue, excluding traffic acquisition costs, below estimates.
What a stock pop we're seeing here, up 16%. And it's all about the projected users that they had in the first quarter.
And if the slide in Meta and Alphabet wasn't enough, Amazon capping a brutal week for tech stocks. A 14% collapse for Amazon shares on Friday alone, its biggest one-day drop going back to 2006. And it's the weight of those individual losses meant heavy losses for the major indices. The NASDAQ 100 falling 4.5% on Friday to cap a 13% slide in April, the worst monthly performance for the index since October of 2008. The S&P wasn't safe either, sliding deeper into correction territory for this week. A lot going on in this market. Let's get straight to our Wall Street Week roundtable. I'm pleased to say joining us right now is Bob Diamond, Atlas Merchant Capital founding partner and CEO. He's also the former CEO of Barclays. And Afsani Bezshkos of Rock Creek, founder and CEO, also joining us right now. Bob, I want to start with you. And really, people just want to know, what really is bothering markets right now?
Listen, it's been kind of carnage in rates. And Romaine, I remember, being on Wall Street Week with the team in January, and I think Afsana, you were on the same session, and we talked about if the Fed, did not begin raising rates soon, if they did not begin going from super easy to neutral, then they were going to have to raise rates further than anticipated. And I think today, overnight Fed funds rates are still at 0.33 of 1%. But you can see in the 2-year and the 10-year and the future forwards for Fed funds rates that rates going forward are going to be raised probably more than we had anticipated just a few months ago. And certainly for growth stocks, that's really tough to take. And we're seeing it, the big impact in the NASDAQ and tech stocks. And I think that's unsurprising given the speed of the rate increases that we've had.
Afsana, does that change the macroeconomic picture, though, for investors?
What it changes is that I think at the moment, everyone is assuming that inflation will continue the way it is. And somehow, for some reason, psychological or otherwise, today really hit investors in a much bigger way, Romaine. than before. So the Fed has been talking about starting to increase interest rates now for a little while. As Bob said, obviously, maybe it should have started a long time earlier. But the main thing is somehow today they realize that supply chain issues are going on. The war is going to be a bigger problem, and interest rates are going to go up. The big question I have is whether in practice, interest rates may not have to go up as much as we're assuming right now, because we are seeing that the market is reacting to what is being put out there now as news. And if that happens, maybe inflation will start coming down a little bit earlier. And we are seeing at the same time that inventories have been built out, consumption is starting to get a little weaker, and the signs are that things could potentially soften a little bit.
Well, we've certainly seen financial conditions come down quite a bit here, and maybe that could make the Fed's job easier, Afsaneh. I am curious as to what you made out of that GDP report that we got this week that showed a contraction of 1.4%.
I think GDP numbers, as we very well know, are generally not super reliable, and they do get adjusted. So on the one hand, if we look very closely, what was really interesting is the fact that imports went up as much as they did, but exports did not. And obviously, with the dollar having been stronger, with the supply chains that we've had, that's not a very big surprise. The area that was really, I think, important, and the GDP really did not get into it, is the fact that the lowest income population in the US still is worse off. And therefore, if that's the case, that will have a much bigger impact on GDP moving forward, because that's the group that will consume more, and their consumption is much more sensitive to what's going on in the economy.
And Bob, when we look at the economic data out there, that GDP report notwithstanding here, you're still seeing relatively strong consumer spending. You have a job market that most people seem to think is still relatively healthy here. Do you think that the economy, is on solid footing, and can it withstand an aggressive Fed?
Listen, I think the numbers were a little bit misleading to what Afsaneh said. GDP is about output, not demand. And, in the fourth quarter last year, it was up 6.9% and down 1.4. But 5.3 of that 6.9 was the buildup of inventories. So if you strip out that big inventory, you can actually look, as Afsaneh said, domestic demand actually improved. Consumer spending was stronger in the quarter. So on the one hand, we still face the same challenges, which is core inflation's at 5%, well above target. The labor markets are too tight. There are 11 million job openings, Roman, and there are 5 or 6 million unemployed. We've never seen a gap that big since we've been, recording these kinds of numbers. So I do think that the Fed has a lot of work ahead of it. I do think it's a very important meeting coming up. Because as I said earlier, we still have rates at, 0.33 of 1%. And we need to begin going from super easy to something that's more normal.
If you had a seat at the table at that Fed meeting next week, what would you advocate for? 25 basis points or something more?
I think they're going to raise 50 basis points. I think if you asked me, I'd say 75. I think they've waited too long. And by the way, the Fed and the Treasury played a blinder in March of 2020. What they did, with the onset of the pandemic was extraordinary. But they waited too long to begin getting back to normalized rates and a normalized curve. This is what we talked about in January, after the economy was fully recovered, after we already had, constraints in the labor market, and after we already had price stability above the kind of targets that they had set. So I think they just waited too long. Therefore, they really need to get ahead of the game. And I would love to see them do 75 to 100 now. I don't think they will. I think they'll do 50.
So, Afsaneh, do you think that it's possible, I guess, for the Fed to effectively catch up with maybe what some people already view as a mistake?
I agree with Bob, by the way, that they will do 50 basis points. I think the important point is the psychology of the markets, right? So what I said earlier, I still believe that if the Fed is starting to talk about 50 basis points, if the market starts talking, which it has already, about 75 basis points, that in itself is going to impact markets and impact inflation and demand. And also, let's not forget, mortgage rates, 5% plus, right? Housing prices, 35% more. They're going to be dampening off demand as we move forward with these kind of prices. And, another part of the economy that we should really look at is as people have acquired goods, then started using services as COVID allowed us to go out of our houses and people are traveling. Once you've sort of caught up with some of these changes in life, demand may not be on the same slope as everybody's expecting it. In that good scenario, we might catch up with inflation better, if I want to be positive.
Well, let's look at real quickly here the earnings season, Afsana, that we're almost halfway through here. We've gotten some of the big names out there. Have you been relatively encouraged by what you've heard, not just with regards to the numbers themselves, but also the commentary out of some of the executives?
You're absolutely right. Expectations were more positive than we expected. And a lot of the numbers came, 77% of numbers were better than we expected. On the other hand, I think, again, the dampening effect is if the underlying consumption will start to weaken, if we assume that as rates go up, and again, the behavioral part of the impact of the rates going up, start impacting companies. You're hearing a lot of CEOs looking forward, the guidance they're giving, whether it's Meta, whether it is JP Morgan, whether it is other company CEOs, all getting us to worry more about what's ahead earlier in the rest of the year.
All right, we need to take a quick break. I do want to get your thoughts a little bit later here on some of what's going on outside of the United States. Sit tight for 1 second. We're in conversation right now with Afsana Beschloff and Bob Diamond, both sticking with us here on Wall Street Week. We'll take a look just ahead at what's happening over in Europe, China, and the rest of the world. This is Wall Street Week on Bloomberg. This is Bloomberg Wall Street Week. I'm Romaine Bostic. We welcome back our panel, Afsana Beschloff and Bob Diamond, still with us here discussing everything that happened this week and hopefully getting a better peek here at what to expect in the weeks ahead. Bob, I do want to start off here with what we saw over the last few days in Europe. New data that seems to suggest that the economic recovery that had been unfolding in Europe appears to be to some degree of jeopardy, given some of the concerns right now with the energy supply and the war in Ukraine here. When you look at the picture there and their economic momentum here, do you see a chance there that Europe can avoid a recession?
It's a great question, Romaine. I actually think Europe is in recession now. I think when we look back, we'll see that they're already in recession. I think, Germany, the strongest economy, is struggling. And I think, we all had a huge supply shock through the system with the pandemic. And now we have two more supply shocks, and each of them may be affecting, or certainly one of them, Ukraine, and the war in Ukraine is impacting Europe more than the US, but also the lockdown in China. So we have two more supply shocks there, and the economy is seriously slowing. I think also that the amount of flexibility that the ECB has relative to the Fed, on any given day, it's less because they don't have the kind of banking union or banking structure that the Fed is operating with in the US. And I think right now, because the economy is slowing down, they have even less flexibility. And, if you look at all this and you just look at the banking earnings in Europe, and you look at banking earnings in Europe versus banking earnings in the US, they're like night and day, and a very good indication of that. So I actually think Europe is in recession.
Well, Bob, I'm curious, and does that then make you a little bit surprised at some of the, relatively hawkish commentary that we heard out of Christine Lagarde a couple of weeks ago?
I would expect that they're going to have to be much more cautious on any change to monetary policy relative to the Fed, yes.
All right. And Afsana, I want to get your thoughts on that as well, particularly from the perspective of the war in Ukraine and some of the supply shocks that we're seeing in the energy space and, for that matter, in the agricultural space as well. I think we've lost her audio. Anyway, Bob.
Big issue.
Go
Can
ahead.
you hear me?
Yes, go ahead, please.
I'm going to say the big issue we're seeing is that you haven't had this level of inflation in Europe for a very long time. The sensitivity since World War II to the word inflation is much higher in Europe. And so the one thing is that while, maybe it is not prudent, as Bob said, if we are in a recession, to start increasing rates, it might not be surprising if Christine Lagarde does start doing 225 basis point increases over the next couple of months. That is not impossible. But going back to what you said, I think the big issue of the world, Europe, of course, but also the rest of the world will be the issue of food, as you said, Romain. So we could be having one of the major, the largest food famines coming up. You saw that the plantings in Ukraine are much smaller than what they had last year, whether it's wheat or corn. You saw the news coming out of Indonesia about palm oil not getting exported. You're starting to see food prices, of course, have all over the world, including in Europe, gone up a lot. So that could be a huge problem for really everyone on the globe.
We'll talk about some of the measures that some of these countries have taken. You mentioned Indonesia. We've also seen some protectionist measures in Sri Lanka as well as Malaysia to protect their own food supply in anticipation that maybe this will get worse. And I'm wondering, are there broader ramifications for that around the world, whether it's just in some of these emerging market nations or even here in the developed world?
You're starting to see it all over, but also it is both food, by the way, and also fertilizer that you do need to produce food. So you're seeing everyone go protectionist. And I think that is that's a theme you're looking at. You remember, like when we look at COVID vaccines and wealthy nations were, sort of hoarded the vaccines. What we're seeing now is all nations starting to sort of look out for themselves and moving away from the last 20, 30 years of globalization towards being much more centered and isolated on their own economies and making sure they're feeding their people, they're getting enough energy. But while we're talking about the negative, again, I always want to look at the positive side, Romain. That might also be the force that moves us to green energy much sooner, because don't forget, green energy is a local source, right? So if you can get to solar, wind, and other forms of green energy, you will be much more reliant on your own and not reliant on Middle East oil or Russian oil or other sources of natural gas.
And Bob, as we speak here now, huge swaths of the population in mainland China is still under some degree of a COVID-related lockdown. We've seen, of course, the ports over there. If they haven't completely shut down, they've certainly curtailed their operations pretty significantly. I'm wondering whether you think the economic ramifications from these lockdowns in China and around the rest of the world could be substantial enough that investors may need to adjust to that potential fallout.
Listen, they're looking at that very closely, Romain. I think it's spot on. As I said earlier, this all began 2 years ago during COVID, or the beginning of the pandemic, with a huge supply shock. And we talked about the supply chain issues that we had. With the war in Ukraine continuing and the lockdown in China continuing, then definitely that's the focus of it. That is one of the many things that investors have to look at in terms of a further supply shock.
Do you think we need China in the same sense that we needed China with regards to global economic growth and global economic stability, that we need that contribution in the same way now that maybe we needed it a few years ago?
I think you saw it in some of the GDP numbers. I think Afsana talked about imports. If I have it correct, imports were up, but sales from the U.S. outside of the U.S. were down significantly. So that was one of the impacts on the 6.9% to minus 1.4. So certainly we want to have trade. Yes.
Now, Afsana, when you look at not just what's going on there in China, but kind of the disconnect now that we're potentially going to see with regards to economic growth from nation to nation, and for that matter, region to region here, the sort of unsynchronization now that we may, I guess, be about to witness here. Do you think that that's something that the economy, at least here in the U.S., that we can withstand that?
I think definitely the cost of production of goods will start going up. And it was interesting in the speech that Secretary Yellen had last week. There was a huge departure, I think, for a U.S. Treasury Secretary from the past. And she talked about producing goods more close to the home market. And she talked about a reform of the multilateral institutions for the next decades. And if you listen carefully to what she said, it would imply that we are moving towards being more self-sufficient in the U.S. and that Europe and other friends of the U.S. will start moving to working together and exporting and importing together. But going back to what Bob said, I don't want us to forget, China last year exported 30% more than the previous year. That's a huge number. So we can't say we're just, with the blink of an eye and that we are out of doing business with China. I think countries will remain reliant on each other, but the degree of reliance, I think, will be changing quite dramatically over the next few years.
Well, just real quickly here, Oksana, I mean, with regards to the war in Ukraine and some of the geopolitical issues going on right now with the rest of the world versus Russia, if you will, here, how does that dynamic change, if at all, with regards to our relationship with China and their relationship with Russia?
The Chinese have been incredibly careful, but let's not forget, if Germany and the rest of Europe stop importing energy from Russia, it will become a very, very cheap source of energy for China. Yeah. And China will do everything in its power to take advantage of that. Right, I think that's the big issue.
All right, we're going to have to leave it there. Our thanks to both of you, Oksana Beschloss of Rock Creek and Bob Diamond. We thank you for your time. Coming up, we're going to have a big look at what's next on Global Wall Street. This is Bloomberg Wall Street Week. Welcome back to Wall Street Week. I'm Romaine Bostic. It's time to take a look at what's happening next week on Global Wall Street. For that, let's get to Juliet Sally in Sydney.
Romaine, the Reserve Bank of Australia's policy board meeting will be the key economic event in Asia this week. Bloomberg Economics sees the central bank hiking rates by 15 basis points to counter consumer price inflation that ran much faster than anticipated in the first quarter. Meanwhile, April's manufacturing PMI data out of China will show just how much the lockdowns are biting after Beijing promised to boost economic stimulus to spur growth, but also defended its COVID-0 policy. Now over to Danny Berger in London. Danny?
Thanks, Juliet. Well, in Europe, it's another week of war in Ukraine, and one of the main focuses for this week will be how the energy story unfolds, with Russia cutting off gas to both Poland and Bulgaria for lack of payment in rubles. Will other buyers be able to access Russian gas without violating sanctions? Or will Europe even start to concentrate on and perhaps enforce a full-on oil embargo when it comes to Russian gas? Now, over to Taylor Riggs in New York.
Of course, a big week here in the U.S. Wednesday, of course, kicking off a big Fed meeting, of course, looking to raise rates maybe by 50 basis points instead of 25, and looking for guidance about the roll-off of that balance sheet. A lot of economists looking for an annualized rate of reducing that balance sheet by about $1 trillion a year. We then push forward to another big day on Friday. It is Jobs Day, looking at a change in non-farm payrolls, adding about 390,000 jobs. It would be a small deceleration from the previous month, but still a very tight labor market. Economists looking at an unemployment rate still of about 3.6%. Back to you, Romaine.
Our thanks to Juliet Sally, Danny Berger, and Taylor Riggs. Coming up, the Fed gearing up for its meeting next week, and the big question is how it battles rising inflation. We're going to hear from the former Fed Governor Randall Kroszner. That's coming up next on Wall Street Week on Bloomberg. Welcome back to Wall Street Week. I'm Romaine Bostic in for David Weston this week. For more insight into the challenges that the Fed faces in its effort to tame inflation, we want to bring in Randall Krosner. He served as a Fed governor back in 2006 to 2009, and now is an economics professor at the University of Chicago's Booth School of Business. Professor Krosner, great to have you here on the program. There's a big debate going on right now in the market, not so much about how aggressive the Fed will be, but I guess more importantly, whether the Fed will be able to engineer that proverbial soft landing.
And it's one of the toughest things to try to do because they've been a little bit behind the curve. They let inflation get a little bit higher than they would have liked. Kept talking about it being transitory, wasn't transitory. Now they've gotten religion and they're moving quickly, or they're hoping to move very quickly. And that's really, really tough because the economy is clearly slowing down. GDP print was a little bit lower than had been hoped for. I think with the continuing war, sanctions, continuing supply shocks, we're going to see the unemployment rate going up. We're going to be seeing GDP growth slow, but they still need to raise those rates. I think the probability of recession has gone up quite significantly. They still might be able to do it, but it's going to be really tough.
It's going to be really tough. And I'm curious if when you look back at past rate tightening cycles and the economic conditions that were around then, are the conditions today worse than they were in some of those previous rate hiking cycles?
Well, they're very different because what we've had with the pandemic is just so unusual. Having these contractions of like a 1/3 of GDP annualized rate, and then growth of 5 or 6% suddenly, and then you've got war, sanctions, all that. So it's really hard to use the past as a very useful predictor of what's going to be going on now, and that's why it's one of the toughest things for the Fed. But I think they really do have to continue on the path for increasing their rates because they have a window right now. They haven't lost credibility. So unlike in the late 70s when the Fed had lost credibility and Volcker had to raise rates to 19% to bring the inflation rate down, they don't have to go that far if they move quickly. But if they don't move quickly, then they risk losing credibility and then have to push rates really high, and then that'll push the economy down much further.
Well, that seemed to be part of the sort of negative market reaction that we saw after the last Fed meeting when we only got a 25 basis point cut. And more recently, Powell has signaled that a 50 basis point cut is certainly on the table at the meeting for discussion next week. And there are a lot of people think that there will be more than one 50 basis point increase, I should say, over the course of the year here. Does that constitute an aggressive enough pace to get us to where the Fed wants us to be?
Well, it's certainly, I think it's as aggressive as the Fed wants to be, at least right now. And as I said, they have this window because they have not lost credibility over the last couple of weeks. Inflation expectations have started to move up more rapidly. And that's the thing that's really scary for central bankers, because if they lose credibility, if inflation expectations aren't moving up, they've got to move up much more aggressively. So what they'd like to do is move quickly now. Paul Volcker is now being invoked by Jay Powell. Yeah. He hadn't talked about him before, and now he's bringing him in because he wants to say, I'm gonna do it. I want people to believe that I'm going to do it, and hopefully by invoking him, he won't have to do it as aggressively and as Volcker did and go to double-digit levels.
Well, he certainly rattled markets when he invoked Paul Volcker's name and Paul Volcker's methods. I am curious. There's sort of a broader, I guess, theoretical question here as to what the Fed is managing. Are they managing inflation? Are they trying to tame inflation itself, or is it more about the expectations around it that they're focused on?
I think it's primarily the expectations around it, because a lot of the shocks are coming on the supply side that are outside of their control. Some of it does have to do with demand, for sure. Monthly supply growth has been very strong, and so it's partially from Fed's actions, but partially from outside. The main thing that they have to worry about is that unanchoring of expectations that we're starting to see a little bit of evidence of, not enough yet, and that's why the Fed needs to move quickly. Also, I think politically, it's much more difficult for the Fed to start moving when the unemployment rate is 5-6% than when it's below 4%.
Well, that leads to a kind of a key point, the idea that we've never really had a soft landing in a rate hiking cycle when the Fed has had to push the unemployment rate up. Do you buy into that?
Well, it's something that's very difficult to do. But as I said, I'm not quite sure that if you just look at the previous cycles, it's exactly like what we're seeing now, because there's so many unusual circumstances. But I do think that one of the challenges is that In the old days, like when Volcker was there, people understood that the Fed has to take the punch bowl away at some point because they're going to be overheating. Over the last 20, 25 years, the Fed's not been taking the punch bowl away. It's always been trying to provide support if there's a sort of a negative shock. And so we've now had a generation or two of both people in the markets as well as policymakers who have not seen the Fed try to pull the punch bowl away. Yeah. It's always been seen as something to provide support. And that's why I think it's going to be much trickier politically for the Fed to do the right thing. I mean, Volcker, of course, had it really tough, but there were a lot of people who understood he needed to do the right thing. Now, there are not that many people around who experience that and understand what the right thing is to do.
Well, let's talk a little bit more about that punch bowl, because the punch bowl is a lot bigger today than what it was back then, and it's probably a little bit more layered. I mean, you were at the Fed back in 06, 09, kind of with the sort of the dawn of the global financial crisis. A lot of the accommodative policy that is in this market right now was born out of that crisis, out of that recession that came out of it, whether it's the fourth iteration of quantitative easing or the near zero rates that we've been at. Basically, a lot of policies that came out of that are still with us today to some degree or another. So instead of just sort of trying to reverse the own policies that Powell himself has overseen, he's now effectively trying to reverse policies that two previous Fed presidents have overseen.
Well, to some extent. I mean, the response to the global financial crisis, I think what we did was necessary to prevent the Great Recession becoming the Great Depression. And then we had a decade where inflation was very low. And then the pandemic hit, and then then Jay and his colleagues sort of opened the same playbook to make sure that we didn't have a collapse of the economy. And I think that was exactly the right thing. The challenge was that there's been so much more fiscal stimulus, both in the U.S. and globally, than there was previously. And you then have supply shocks, and then you have war and sanctions, that it's been a much more complicated set of things for the Fed to respond to. The challenge was that it would have been much better if the Fed had not said, this is all transitory, this is just supply shocks outside of our control. We can take our time to deal with it. If they had acted a little bit earlier, we wouldn't be quite in this pickle. But I think they now realize they need to move quickly to do it. I think a significant slowdown would have been inevitable, even if they had started earlier, because of all the other shocks that are coming in.
Yeah.
But I think the probability of a recession is much higher than it had been.
Well, Powell, at least publicly, is of course trying to talk that idea down here. I want to bring you some of the comments that he made back in that March 21st speech before the NABE conference, where he effectively said that there have been recent examples of the Fed hiking into this type of environment and avoiding recession. He specifically cited 1965, 1984, and more importantly, he invoked Alan Greenspan's name with that rate hiking cycle that we saw in 1994, where we effectively went up 3 full percentage points in barely a year's time. And he uses that as an example, at least in his words, that you can avoid a recession and at the same time tame inflation.
That's for sure. It's by no means necessary. And so I think the Fed could do it. But I think you're in a very different position. I think 94 is probably the closest example, both because it's closer in time and trying to bring inflation down relatively quickly, making sure inflation expectations don't get out of control. But we're in a very different environment. We're in a war and there are major sanctions that are in place. Mm-hmm. We are facing lots of supply disruptions. So it's a different environment than in 94, and I think a trickier one. And it's, it doesn't really matter whether it's the Fed's fault or not. The Fed owns it. If inflation is high because of supply disruptions or sanctions or war, the Fed can't say, well, it's not our fault. The Fed owns high inflation and has to respond to it. And that's why I think a lot of it is about inflation expectations and not just the particulars of what may be driving inflation in one particular month or another.
All right, well, here in 2022, final question here for you, Dr. Krosner. If you were still on the Fed committee, would you advocate for a 25 basis point hike, 50 basis points, or something more?
So I think they need to move 50 at the next meeting and also give a very clear plan for starting to reduce the balance sheet. I think the Fed is going to continue to focus on the interest rate as their main policy tool. I don't think they're going to say, oh, well, we'll use the balance sheet as a policy tool. But I do think that they need to give a clear plan for the runoff of the balance sheet. So it effectively would be more than a 50 basis point cut because they'd be talking about pulling back the balance sheet.
All right. Really appreciate getting your insights here on that. Dr. Randall Krasner, of course, professor over at the University of Chicago and a former Fed governor. Coming up, former Treasury Secretary Larry Summers on the challenges the Fed is facing and the odds of staving off a recession. That's next on Wall Street Week. Welcome back to Wall Street Week. I'm Romaine Bostic in for David Weston. Ahead of a consequential meeting by the Fed next week, we want to bring in our Wall Street Week special contributor, Larry Summers, of course, Harvard University professor and former Treasury Secretary. Larry, there's a lot of focus out there right now about the pace of rate hikes, the number of rate hikes. There's a little bit less discussion, though, out there right now about the balance sheet, the potential balance sheet runoff that Jay Powell has said he would provide a roadmap for at this meeting. What does a reduction of that $9 trillion balance sheet mean, if at all, for the inflation mandate?
Look, I think it's the right thing to do. I think, frankly, it's well overdue. It was very hard to understand why, when we were in the midst of the biggest house price run-up ever, that the Fed was buying mortgage-backed securities on a substantial scale. So I think the move towards rundown of the balance sheet is overdue and appropriate. I don't think it's going to have a large independent effect. I think much of the effect that balance sheet moves have had in the past has been because of their signaling impact on monetary policy rather than their direct impact. But it will certainly add to the monetary tightening that we're going to see. People have estimated that it may be the equivalent of 1 or possibly 2. I think 1's a bit more likely, 25 basis point rate hikes.
And when you pair that with the rate hikes that at least the Fed says are on the table, a potential 50 basis point hike at this meeting and maybe another one at the meeting in June here, do you think that that would give the Fed, I guess, enough ammunition to tamp down inflation, or would they have to continue going forward with additional rate hikes?
Look, I think it's hard to say. I think ultimately inflation depends on financial conditions, and what happens to rates is one important part of it, but it's certainly not the only important part of it. My guess would be that the Fed's going to need to go further. I think that in order to reduce inflation, you need to raise real interest rates above their neutral level. If we've got 3 or 4% inflation and the neutral real interest rate is, as the Fed believes, 0.5%, then you're going to have to be up in the 4.5, 5 range to get inflation meaningfully down. Right. And that's my best guess. Well, I think the Fed's making a mistake when it speaks of raising rates above the neutral rate and treats that as meaning rates above 2.5%, because that 2.5 is only the neutral rate if inflation is down at the 2 level, which is what the debate is about. So my best guess is that rates are going to have to go up more. If they don't, it will be not so much because we suddenly get good news on inflation, but will be because we get worse news on the economy than many people expect. So I think we're looking at a pretty difficult situation.
So when it comes to the news on inflation, though, I mean, we have the latest employment cost index, which was released this week, showing that the employment cost index rising the most that we've seen on record in the first quarter here. We know that wages, compensation, benefits tends to be much more sticky, less transitory than some of the other elements of inflation out there. How would you suggest that the Fed address that?
Look, I think that we should be thinking in terms of wage or labor cost inflation as a kind of supercore measure of inflation. Seems to me it's hard to escape the conclusion that it's running at 5.5% or more. And with labor markets tight and creating several 100,000 jobs a month, I think it's likely that rates are going to rise further of wage inflation. And that suggests to me that while used car prices and semiconductor prices and oil prices will fluctuate month to month, that we have an underlying rate of inflation increasingly being baked in that is well above the Fed's target range. And that's why I think they need to be raising rates above the neutral level. They could somehow get lucky on this. It could be that we're going to see wage inflation subside of its own accord. But gosh, as I go around, as I talk to people, what I see and hear much more is labor shortage talk, the need to ratchet up wages to hold on to workers, the need to ratchet up wages and labor costs in order to attract people, the pioneering of new kinds of employment benefits that are costly in order to maintain the morale of workers. And all of that, I think, contributes to inflationary momentum.
All right, so as the market sort of focuses in on the Fed, and I guess more importantly, whether the Fed is willing to sort of stick by this sort of reduction in accommodative policy, a lot of people are looking overseas, Larry, and the decision this week by the Bank of Japan to effectively maintain its accommodative policy for a much longer period of time and signal at least to the market, that they're fairly comfortable with the weaker yen and some of the knock-on effects to their economy here. When you see that move there by a major bank like the Bank of Japan, how do you think the reaction would be if the Fed itself were maybe to pause their accommodative cycle?
I think you got looking at very different situations in Japan and the United States in terms of inflation. In the United States, we've got inflation at a place where the American people regard it as a huge problem in a way they haven't for 40 years. We've got almost every leading indicator of inflation pointing upwards. We've got epically tight labor markets. I think the situation's very different in Japan. I think their situation still has more in common with the pre-COVID situation we had in the United States, where you're trying to overcome a force of secular stagnation, in their case, I think driven substantially by the fact that they now have a quite rapidly shrinking labor force. So I think their decision in a very different context has been broadly appropriate.
All right, Larry, I have to ask you about the other big news, kind of overshadowing everything else, was the news here that Elon Musk, of course, the CEO at Tesla, has made basically a personal bid for Twitter, a bid that Twitter itself has accepted, and now we sort of await for shareholders to weigh in on whether they're willing to accept this deal. What were your first thoughts when you saw this?
I think it's worrying when America's wealthiest people on a private and individual basis own America's most important communications platform. I think that at least raises questions about how well democracy is going to function. And my hope would be that we could have some, I don't think it'll happen, but I would hope that we could have some serious bipartisan dialogue and soul searching around those issues. It may be that ultimately they will be stewards of a very responsible kind. On the other hand, I remember learning in my high school history courses, and I don't know what exactly is true, that the Hearst newspapers got us into the Spanish-American War because that's what William Randolph Hearst wanted to do. And he was able to use his newspapers to stoke everybody up with incidents that might have been true and might have been false. And it seems to me that as I look at what's happening at Twitter, as I look at, and I think the stewardship has been entirely responsible to this point. The world's second wealthiest man owning the Washington Post. I think the questions need to be given very serious thought. I'm not prepared to make a public policy recommendation, and I know of no basis for thinking that this transaction has anything illegal about it. Mm-hmm. But I must say, I'm uncomfortable, and I think there really does need to be some serious reflection.
All right, well, a lot of people keeping an eye on this. Larry, always appreciate getting your insights. Special Wall Street Week contributor Larry Summers, we thank him for his time. Coming up, the last time the Fed raised rates 50 basis points was more than 20 years ago. We'll take a look at some similarities and differences between then and now. That's next on Wall Street Week on Bloomberg. Finally, one more thought. What to expect when you're expecting. I'm not talking about parenthood. I'm talking about what happens next week at the Federal Reserve. The old adage that the Fed's job often ends up being less about managing the economy and more about managing people's perception of the economy. Expectations of inflation in the labor market, to be precise. While the central bank hiked interest rates by a 0.25 percentage point in March, traders are now pricing in more than 2 percentage points of additional rate increases this year alone, including at least 3 straight half-point bumps.
There's something in the idea of front-end loading whatever accommodation one thinks is appropriate. So I would say that 50 basis points will be on the table for the May meeting.
So there you have it. The market and the Fed appear to be on the same page. No surprises next week, right? Well, history may end up muddying the path to the future. Go back to the halcyon days of the year 2000, May 16th, 2000 to be precise, when Russell Crowe's Gladiator ruled the box office.
Are you not entertained?
Louis Rukeyser was still on the air.
Good evening, I'm Louis Rukeyser. This is Wall Street Week. Welcome back.
And a barely 3-year-old company called Netflix was renting DVDs through the mail. It was pre-social media, pre-iPhones.
So the Federal Reserve did what everyone expected. It raised the interest rate.
It was a half-point increase in the benchmark Fed rate to 6.5%. Policymakers citing disparity in the growth of demand and potential supply that could foster inflationary imbalances. Sound familiar? At the time, the internet bubble was expanding to what would soon become its breaking point. And less than a year later, the U.S. economy entered an 8-month recession. One big difference, though, between then and now, consumer price inflation peaked at 3.75%. That's less than half of the 8.5% pace we're feeling today. And maybe that's why some traders are betting on a rate hike of 0.75 of a percentage point. Well, the Fed hasn't engaged in that type of shock and awe since late 1994, when after 2 consecutive hikes of 50 basis points, it did indeed surprise the market with a 75 basis point hike, which was then followed by another 50 basis points 2.5 months later. It sounds extreme, but this actually appears to be the holy grail for Jerome Powell and the current Fed. Powell has publicly cited the 1994 to 1995 rate hiking cycle that took rates to 6% from 3% in a year's time as an example of how to tame inflation without tipping into recession, the so-called soft landing. I'm Romaine Bostick. This is Wall Street Week. We'll see you next time.